Imagine you're investing your hard-earned money because literally everyone online is screaming that this one stock is the next big thing. You're scrolling, you're seeing these ultra-realistic images of guys with supercars, massive green trading candles just shooting up your screen, and it feels like an absolute sure thing, right? So you buy in, but then what happens? A few weeks go by, and it just drops. And then it drops again? Well, welcome to this explainer. Today, we're tearing apart the most dangerous market trap of 2026. This is a massive financial illusion we're breaking down, and honestly, what we uncover today is going to completely change how you look at the stock market. You definitely want to stick around to the end for this. So why are millions of people making this exact same mistake literally right now? Look, I'll be totally honest. I have completely felt that pull myself. I remember sitting there staring at screenshots of these crazy overnight profits, feeling this intense urge to just hit that buy button. It's human nature. But falling for this viral hype is quietly destroying portfolios left and right. Let's look at why. Okay, so the real enemy here is FOMO, fear of missing out. It's that awful stomach-churning pressure you get to just act, buy in, and join the crowd when everybody else seems to be getting rich. But here's the really suspenseful reality of it all. By the time you actually hear about a trending stock on social media, that excitement is already entirely priced in. You're not early to the party at all. You are literally buying at the top. Now, right now, the market is putting on a dazzling magic trick. If you pull up a real-time trade graph of the major indices, it looks like this unbelievable melt-up, right? It's just blowing through resistance levels. But if we peel back the curtain, this massive run is being carried entirely by a super concentrated boom in AI and semiconductors. They're basically throwing up a huge smokescreen over the rest of the economy. And guys, what is hiding behind that smokescreen is actually kind of terrifying. Check this out. 50%. Just let that sink in for a second. Despite the record all-time highs you're hearing about on the nightly news, only 50% of the stocks in the S&P 500 are actually trading above their 50-day average. That means half of the largest companies in America are secretly in a downtrend right now. The foundation of this market is incredibly narrow, and it's deeply, deeply fragile. If I were doing a live drawing right now, I'd literally draw a massive dividing line right down the middle of the market. On one side, you have the AI and tech giants. They're seeing booming profits, right? Massive cash flow. They are essentially putting the entire market on their shoulders. But on the other side, the broader market is quietly struggling just to keep its head above water. Sure, the massive cash sitting on the sidelines has propped things up so far, but come on, that cannot last forever. So what actually happens when we look underneath the surface? Well, there's a massive looming macroeconomic threat that all this daily social media hype completely ignores. It is happening right in front of us. And trust me, you are going to want to hear what's coming up next. Okay, we have a major Federal Reserve change taking place on May 15th. New chair Kevin Walsh is stepping in, but honestly, he is walking into an absolute trap. Investors are out there praying for rate cuts to bail out the struggling half of the market, but Walsh's hands are completely tied by inflation. Cutting rates is virtually impossible right now, and let me tell you, the broader market is totally unprepared for the fallout. It's basically a brutal chain reaction. Step 1, global war disruptions are keeping energy prices really elevated. Step 2, because energy is expensive, CPI inflation is going to stay stubbornly high at an estimated 3.6% headline rate, which is way above the Fed's goal. And step 3, because that inflation is so sticky, cutting rates in an economy that's already overstimulated by AI spending would literally be like pouring gasoline on a fire. We likely won't see a single rate cut in 2026. And that brings us to this staggering number, 11.6%. Brace yourselves, because this is what Wall Street veteran Mark Chaikin calls the pain index for the everyday consumer. If you want to understand why the broader stock market is secretly failing while tech giants soar, you have to look at what average people are actually feeling in their wallets every single day. Let's do the math on this. When you take a 6.4% 30-year mortgage rate, which makes buying a home basically unaffordable for millions, and you add that to $4.60 for gasoline at the pump, you get this crippling 11.6% index. This forces everyday consumers to make brutal, uncompromising financial choices. This isn't just data on a spreadsheet, right? This is the reality of families trying to decide what they can actually afford to put in their grocery carts this week. So where is this consumer pain quietly destroying the stock market? Well, with cash strapped, people are choosing basic daily groceries over big, flashy purchases. And if you're holding stocks in these specific, vulnerable areas, just hoping for some viral breakout,
you are in serious trouble. Stick with me here because this next part is absolutely crucial for your portfolio.
The reality of sector health right now is just stark. Look at this breakdown. We're seeing heavy bearish ratings hitting consumer discretionary because people just aren't buying cars or renovating homes right now. Consumer staples, also bearish because brand loyalty completely fades when people need cheaper store options. Even utilities are bearish due to rising energy costs. Meanwhile, only isolated tech giants like Alphabet remain bullish. It creates this wild illusion of a healthy market while literally everything underneath is flashing red.
And the reality check for this is staggering. Whirlpool, the largest appliance manufacturer in the US, they just had their biggest one-day stock drop in 20 years, 2 decades. They explicitly warned that we are already in a recession-like environment for major big-ticket items. The consumer is pulling back hard, which brings us to arguably the most expensive mistake you can make right now. Confusing price with value. Look, a viral stock might be shooting up in price today just because of internet hype, but value is how that company actually earns money and survives in a high interest rate environment. Think about it. If a company's survival relies on strapped consumers who literally can't afford their products anymore, that stock is a ticking time bomb. It doesn't matter how many millions of views its hashtag gets. This leads us to an absolutely incredible insight from Mark Jakin. He says bottom fishing is the most expensive sport in America. When famous consumer brands start crashing, it's so tempting, isn't it? You think, oh wow, this great company is on a massive discount, I've got to buy it. But trying to catch these falling knives in a deeply bearish sector, it will absolutely destroy your wealth. Take Home Depot as the perfect example of this trap. You might pull up a live chart, see it's down 40% from its highs, and think, bingo, it's a bargain. But high interest rates have totally frozen the housing market. If homes aren't selling, people aren't doing heavy DIY projects. So in this specific macroeconomic environment, it's not a discounted stock, it is a broken stock. So what's the move? How do smart investors build a genuinely hype-proof strategy in this crazy environment? Now that we've totally stripped away the illusion and bypassed all that social media noise, it is time to take action. Let me sketch out the exact playbook for surviving and actually thriving while the crowd gets distracted. Okay, here is the strategy. First, smart investors are keeping about a 20% cash reserve right now. Second, they're aggressively pruning the weak, bearish consumer stocks out of their portfolios, getting rid of them. Third, they absolutely refuse to bottom fish for failing consumer brands. Just don't do it. And fourth, they're patiently waiting to use that cash to buy proven, strong AI and semiconductor winners, but only when they naturally dip in price. Ultimately, your absolute greatest edge in the market is not predicting the future, it's discipline. You gotta slow down and stop chasing whatever happens to be trending on your timeline today. Do your own independent research on a company's true value. Diversify intelligently away from just one hyped-up sector, and completely remove that emotional trap of FOMO from your decisions. Remember, the market rewards patience, not panic. So I've got to ask, what is the biggest investing mistake you've ever made? Did you fall for a viral stock that completely tanked? Look, jump into the comments below and let me know. Sharing your personal experience might honestly be the exact lesson that saves someone else from making the same mistake. If this explainer helped you spot the 2026 hype drop, do me a huge favor and subscribe to NexClaim for more wealth building strategies and deep market insights. Catch you next time.